All right, so we'll be talking about evaluation and review, which is chapter 9. And I'd love us to round this chapter up. It's not that voluminous, unlike audit evidence. I'd like us to look at it that if we didn't exhaust the units, the sessions by 10 p.m., please, I would like us to, or I'll crave our indulgence to please shift it to like 11 p.m. so we could close this evaluation and review subject, so that in the next class we look at group audits. Okay, so in the next class, we look at the past question and answers, then we look at group audits over the weekend. I'm believing and hoping we could close these two chapters with the past question and answer, so that Monday we can concentrate on the pilot question and answer. So please, I beg your pardon. If we don't conclude before 10 p.m., we may need to extend it a bit longer. We just have 5 units or 4 units, and we should be able to exhaust that in this class. So pardon me. And please be patient. Let's see how we can run through this a bit tricky subject, evaluation and review. So by way of content on this chapter, we'll be looking at the learning objective as usual, the learning outcome as usual. Then the first unit will be the review stage of the audit. We'll also look at the next unit on opening balances and prior period comparatives. And the guide is ISA 510 and ISA 710. We'll look at the next unit on subsequent events, which is ISA 560. Then we'll look at going concern, ISA 570, and we'll wrap up the chapter. So by way of learning objectives, candidates are expected to learn on evaluation and review of audit after field work. So after you've done the field work, you need to report. But before the reporting, you need to ensure that you review your work. And the chapter will introduce us to some depth of completing the phase of the audit, and also looking at the ISAs to be able to integrate them and help guide auditors in preparing a quality report. So after this, we should be able to learn, and our learning curve should go up by being able to describe the process and considerations for evaluating misstatements in financial statements as per the guide ISA 450. And also, we should be able to confidently learn about opening balances and prior period comparatives, and also audit them in compliance with the guide on these standards ISA 510 and 710. Also, we should be able to explain how to audit subsequent events after reporting dates in accordance with ISA 560, and also summarize the going concern concept, the going concern issues, and how to apply and comply with ISA 570 on going concerns generally. So that's generally the objective of this paper, of this chapter, and also the outcome. Our learning curve should go that direction of understanding pragmatically how to also address questions in the exams. So let's go to the first unit, speaking to the review stage of the audit. Now, the first section under that unit is the need for a review. There's a need to review the audit work after the field work is done. So after testing controls, substantive testing, test of procedures, test of details, and the whole job done on the field, the auditor must step back and evaluate the whole overall picture. That's the core idea of evaluation and review. After doing everything on the job, he needs to evaluate and check what he has done. And the purpose is to review and evaluate all gathered audit evidence. And that evidence has to be strategically dissected by the auditor to see which ones are relevant and which ones are irrelevant, which ones are material, which ones are immaterial. And in reviewing them, he needs to ensure the financial statements are consistent, reasonable, and complete based on the evidence he has gathered. So in performing this review, the auditor needs to go beyond detailed testing and also consider other events or information affecting the statements that are not really a product of his audit tests. This is very important. He needs to apply analytical procedures at the final stage to confirm that the accounts make sense. and everything he has gathered is in tandem with what management has presented in the financial statements. And the essence of this is to test the facts. So testing finds facts, while review confirms the story holds together. Very important. So substantive testing, test of details, test of procedures, audit procedures done, finds facts, gathers evidence. But reviews confirm that these evidence are true and they are what management or stakeholders' attention. That's what it means. So that's the essence and the need for a review. Very key. So the next session we'll talk about evaluation of misstatements based on ISA 540. So please, if you have questions, if you have concerns, observations, as I'll try to be running, I'll try to be fast. So please interject freely, stop me. It's quite a challenging subject. So let me know if you have issues around some of these thoughts, and let's try to address them as much as we can. All right, so I was saying the evaluation of misstatements based on ISA 540 after the job has been done is to assess whether errors found during the audit make the financial statement materially misstated or not. So in evaluation and review, the evidence gathered are much, some material misstatements or some material evidence, some immaterial evidence. So the essence of going back to check or evaluate and review the findings is to ensure that material misstatements that affect financial statements are brought to the fore and management are aware of it. But immaterial ones that are insignificant, maybe control deficiencies that could be addressed without misstating items in the financial statements. And the key focus in this evaluation speaks to identifying uncorrected misstatements, speaking to the amounts, the classification and presentation, the disclosure of the same. So evaluating and reviewing uncorrected misstatements based on their size, materiality, is the key focus of this review. And also comparing the total misstatements with materiality set at the planning stage and at performance completion and review stage is what the auditor wants to do. And that's his objective. So his action around first accumulating misstatements, whether material or immaterial, but where misstatements are trivial or immaterial, then he needs to revise the audit plan if errors approach materiality, are insignificant, and if they are significant, then he has to use them to speak to management or bring it to management's attention. The third area is to communicate misstatements to management for correction, especially the material ones. And those are the actions the auditor should take. And if these statements are not corrected, he needs to obtain reasons why and also assess their impact on the financial statements. And also, if they are not brought to the attention of stakeholders or shareholders, what will be the effect? So it's very important that the auditor's actions in this would culminate in which decision he should make and also what kind of report he would provide. Also, the fifth action is to reassess his materiality based on ISA 320. And reassessing it is based on the overall materiality, the revised materiality, and the evidence gathered based on the auditor's findings. And the sixth one is to determine if uncorrected errors are material individually or in a group. In a group, talking about the components of a financial statement. So misstatements could happen in, let's say, the statement of financial comprehensive income, for example. Maybe the profit before tax is materially misstated based on some items or transactions. But then some postings of transactions could be individually materially misstated, like a transaction, for example, posting of an invoice. An invoice amount can be immaterial, and it was found among a sampled invoice by the auditor. But that invoice culminates in revenue generation. So the revenue is talking about the group, and the invoice that leads to revenue recognition is the individual posting. So the auditor needs to determine if uncorrected errors are individually misstated or as a group, or the component of the financial statement is misstated in total. He also needs to inform those charged with governance about the uncorrected misstatements. He also needs to obtain written representation on what he has presented to them based on their materiality. So he needs to obtain written representation from management, whether they are material or immaterial. And mostly for the immaterial, he could categorize them under control deficiencies and immaterial findings, but that need to be addressed. Number 9 is to document trivial thresholds. All misstatements and final conclusions, whether material or immaterial, has to be documented by the auditor. And the essence is that every error counts. Little, large errors, they count. Together, they tell whether the truth still stands. So whether little errors, whether large errors, whether material errors, whether immaterial errors, the auditor needs to document them, bring them to the fore. Some may lead to material misstatements in the financial statements, and some may not. But then it now depends on the auditor's judgment and what he wants to achieve based on his audit objective. This is very important, and that speaks to evaluation of misstatements based on ISA 540. Okay, so let's move to the next section, if we don't have any questions, on other areas of evaluation and review. So other areas of evaluation and review, the auditor needs to focus on areas in the final review of the financial statements or evidence he gathers, and also evaluate, number 1, the opening balances compared to the closing balances of previous accounting periods. So the opening balances and the comparatives needs to be assessed and reviewed. And this is to ensure consistency and accuracy with prior year balances. And this is very important because in reviewing closing balances, that will be the brought forward opening balances that will be used for the current year. So that has to tally, and the auditor needs to ensure and confirm that. Number 2, other information speaking to review statements or reports published with the audited financials are to help address inconsistencies. Are to address inconsistencies. So other information, review statements or reports published with the audited financial statements are to be reviewed by the auditor to ensure that statements tally with figures. And number 3, subsequent events in identifying post-year end events affecting financial statements. So after financial statements are produced, events after reporting date could crystallize, and they will need to integrate these events, for example, litigations, court cases, fire incidents, and the likes, into the financial statements, because some of these events may be material. Number 4, the going concern concept around assessing if the entity can continue operating for a foreseeable future. Yes, please, TA. Go ahead, your hands are up.
Good evening, sir.
Yeah, good evening.
That number 3, subsequent report. Are you referring to IAS 10, event after reporting date?
Exactly. Events after reporting dates. Exactly. That's what I'm referring to.
Okay, thank you, sir.
All right, you're welcome. Okay, so we'll be coming to that. We'll be looking at another session on IAS 10, events after reporting date. So thank you for being very smart and sensitive on that. It shows you are well aware of stuffs that have to do with this subject. So I was speaking to going concern, and I said the auditor needs to assess if the entity can continue operating for the foreseeable future. So it's not whether the financial statements present a true and fair view. The going concern concept is very critical. It's a high risk area. If an organization is crashing and their financial statements are okay, that's a big problem for the auditor. You are seeing that the financial statements, the posting, the technicalities, everything tallies, but the organization is drowning. You need to save the organization first, and that's what going concern is all about. He needs to predict. He needs to point out that, CEO, from your numbers, this company is going down, and that's part of the essence of evaluation and review. The essence of this is to ensure that the final review and the numbers, the notes, the narratives stands the test of truth, and also that the company is sustainable. This is very key. So these are other areas of evaluation and review that auditors need to perform. Very key. All right. So that's the end of this unit in brief, speaking to the review stage of an audit, and also a general introduction on this unit. Okay, so let's go now into the subject, speaking to Unit 3 on opening balances and prior period comparatives. ICAN 510 and 710 guides us on this subject. So the first section under this will be looking at opening balances and comparatives. And the key standards that guide this is ICAN 510, which is the initial audit engagements, talking about opening balances. So whether we have an old auditor continuing the job for the current year or a new auditor taking over from an old auditor, the opening balance of last year, the closing balance of last year has to culminate in the new balance for this year, and that has to tally, and the closing balance has to be confirmed from its derivation, from its origin to its derivation and confirmation as the original balance. So for example, inventory balance, receivables balance have to be confirmed as valid and clear. So for inventories, for example, the auditor has to ensure that stock counts were held, the disclosures around inventory, and the valuation, the confirmation of stock has to be in place. So in reviewing audit working papers, for example, of the outgoing auditor, the new auditor has to confirm this to ensure these balances are accurate to some extent. Then ICAN 710 talks about comparative information on the FS, and the auditor needs to ensure that opening balances agree with prior year audited figures, and also consistent accounting policies are applied across several years he's auditing. This is very important. Also, consistent classification and disclosure between several periods should be confirmed by the auditor. So if we have the same auditor, like I was providing a scenario, if we have the same auditor as last year, usually there is a straightforward confirmation because he's the one that audited last year and he did the job. And this year, he's carrying forward those balances. That is usually okay. But if there's a new auditor, he has to verify the opening balances. For example, 2024 opening has to be that of 2023 closing, like I said. And any errors in opening figures, for example, inventory I used, which is a major issue, may distort the current year's result. And that is why confirmation of opening balances is very important for the auditor, whether the old auditor or the new auditor. So it's key for you to understand that past figures shapes the present truth. So you need to check the bridge between those years, what you are carrying from last year to this year. Do they tally, and do they speak the correct numbers? This is very important. So that's it about opening balances and comparatives in brief. Now let's look at ICAN 510 on initial audit engagements, speaking to opening balances. And this is applicable when prior year figures are not audited, or when prior year audits by another auditor or predecessor has not been provided to the incoming auditor. So the objective of ensuring and providing audit opening balances is that There are no material misstatements affecting current figures, and that's why opening balances are very important to confirm. Another objective in confirming this is to reflect consistent accounting policies or properly disclosed changes in the FS. That's the objective of ensuring that opening balances for initial engagements are provided. And audit procedures, speaking to the last year's financial statement and audit report, if provided by a predecessor auditor, needs to be checked by the current auditor. He needs to check that closing balances from the prior year are brought forward to the current year and that all procedures have been followed and applied meticulously. The auditor also needs to verify accounting policies are consistently applied across all transactions, and he needs to gather evidence by reviewing his predecessor's working papers, where applicable. He also needs to use current year to test last year's posting. So, for example, cash receipts needs to confirm prior receivables. And where you have credit sales, he needs to also confirm that. He also needs to perform specific audit tests on opening balances to see if they are actually correctly stated. Very, very important. So if the auditor finds issues, he needs to perform extra tests. If he finds issues around the closing balances and they don't tally with the opening balances he's speaking, he needs to perform extra tests, assess materiality effect and the misstatement on the financial statements, and also communicate to those charged with governance based on ISA 450 to correct them. So the hook around this, there's a mnemonic here. The auditor needs to read the financial statements prepared by the outgoing or the former auditor. He needs to check it. He needs to confirm it to obtain sufficient appropriate audit evidence and communicate properly and ensure that there is consistency across application of these accounting policies in the previous financial statements. So that's it about initial audit engagements, especially where we have new auditors taking over from old auditors. These opening balances needs to be confirmed, and where there are issues, it needs to be tested, and details have to be provided to validate most of the balances and the work done by the outgoing auditor. All right, so let's see ISA 710 on comparative information, because these corresponding figures needs to tally with the comparative financial state. So you have a lot of narrative. Those narrative needs to tally with the figures on the financial statements. The purpose of this is to ensure prior period figures shown for comparison are accurate, consistent, and properly classified. That's the essence of corresponding figures and the narratives in the comparative financial statements. So ISA 710 applies to all audits, while ISA 510 on opening balances applies mainly to new audits and opening balances, but 710 applies to all audits. And the auditor's focus around ISA 710 is comparative information must agree with the previous year's audited figures. So any information provided in descriptive form or narrative must agree with the previous audited figures, and this needs to be properly stated in the FS. And also the use of consistent policies or disclosure, and any changes need to be applied correctly. And this required procedure speaks to performing limited reviews. Involves less testing than what the auditor is going to do for the current year. It's just to validate what was done in the previous year. And also any investigation that indicates material misstatements in the figures of last year will need to be carried out based on the results of the testing that the auditor has performed. He also needs to obtain written representation covering all periods in the auditor's opinion, or the former auditor's opinion. So if the same auditor is auditing that audited last year is doing this year, then it's straightforward because comparatives are already verified. But if he's a new auditor, he needs to follow ISA 510's procedure to confirm opening balances. So a key takeaway is that comparatives must be accurate. It must reflect the true picture and true story. It must be consistent and compliant, even if less extensively tested by the new auditor. This is very important on comparative information and corresponding figures and comparative financial statements. All right, so that will be the end of Unit 3 on comparatives and opening balances for prior period reviews. Excuse me. All right, so let's look at Unit 4, speaking to subsequent events, and the guide we have is ISA 560, subsequent events. So the first section is ISA or IAS 10, and that was what TA spoke about. So we'll be looking at this session on subsequent events, which is ISA 560, and IAS 10, events after reporting date, and also IAS is the international financial reporting standard or international accounting standard that guides events after reporting date, and auditing it is ISA 560 that guides that. So events after reporting date speaks to financial statements reflecting material events that occur, after the reporting date, but before approval of the financial statements. Take note of that. Events after reporting date speaks to issues, material issues that have occurred after reporting date. That is, the financial statements have been prepared, but has not been approved. So they need to be integrated. They are material events, and that's why these are events after the FS have been prepared. And the integration and correction of some of these events are necessary because the auditors and management must consider these post-period events, these happenings, to ensure that financial statements still present a true and fair view. Because these events that happen after the financial statements have been prepared, but maybe it has not been approved or published by management, some of these events are material that they may need to be considered and integrated into the report. So two key standards we spoke about, we said IAS 10, events after reporting date, defines and guides accounting treatment of such events, while ISA 560, the audit standard or the audit guide, guides auditors on how to identify, evaluate, and respond to these events after reporting date. So the key takeaway here is that post-reporting events can significantly affect financial statements in nature and size and amounts. And that's why both management and auditors must review and adjust or disclose some of these events as needed, as necessary, so that decision makers, stakeholders, and shareholders will be aware to make appropriate decisions. So that's a general introduction on IAS 10 and ISA 560. So what is the purpose of IAS 10? What is the purpose of this IAS? And how do we use it to audit or perform our audit assignment? Now, the main objective of IAS 10 is to determine when to adjust financial statements for post-reporting events. So that's number one objective. You need to determine when to adjust issues, events in the financial statements after it has been prepared. When an event crystallizes and is material after financial statements have been prepared, it needs to be considered. And secondly, another objective is to disclose specifically such events before financial statements are approved or issued for publication. So those are the main objectives. So what are the definitions of these events based on IAS 10? Events that are favorable or unfavorable, that occurred between the reporting date and the date the financial statements are authorized or issued. So financial statements have been prepared, but they've not been approved, and an event crystallized. Let's say the major purchase of another company happened, and that's in tune of billions. That has to be integrated before the financial statement is authorized. That's a favorable condition. Then, for example, a litigation or a major fire incident that engulfed a property, and the plant equipment there got burnt. That's an unfavorable event. That has to be integrated before the financial statement is approved or signed. So that's an example of two events. One is a major purchase, a major merger, a major acquisition in billions. That has to be reflected. So those are events after financial statements have been prepared that needs to be integrated before the financial statements is approved or approved. So this type of event speaks to adjusting events. There are adjusting events, and these adjusting events provide evidence of conditions existing at the reporting date. So financial statements have been prepared but not approved. So adjusting events, they require adjustments. And we have non-adjusting events that arise from conditions after the reporting date. The disclosure has to be provided if the events are material. Then there's need for adjustment. But if they are not material, then there's no need for adjustments. So non-adjusting events depends on the materiality of those events. This is very, very key to understand. So key takeaway on IAS 10 is that this standard ensures users receive financial statements that reflect all relevant post-reporting information through adjustments or disclosures. So adjustments may be numbers that are integrated into the FS, while disclosures are just provision of description or narrative on what happened, but do not affect the numbers that have been prepared in the financial statements. So take note of that, and that's the purpose of IAS 10 to guide us on events after reporting date. So the next section will be speaking to accounting for adjusting events after the reporting date. How do we account for these events in the FS? Now, the key principle on IAS 10 is that if new information confirms that an event exists at the reporting date, the entity must adjust its financial statements according to these events. So information that has been provided that an event exists at the reporting date, even though the financial statements have been prepared, must be reflected in financial statements accordingly. And some of these events could be court cases settlements after the year end and after financial statements have been prepared, confirming an existing obligation. So if, for example, the company was fined a material amount, whether the company was fined, so it's not in their favor, or if they were in a case and they got a judgment that was in their favor with a material amount, that has to be integrated and adjusted in the financial statements. That's number one. Number two, new evidence of asset impairment that existed at the reporting date. Impairment is the downward review in the value of assets. So if the new evidence from maybe valuers or experts provided validates this event, then it has to be adjusted in the financial statements as at the reporting date. Another example is final determination of purchase cost for assets brought to the attention or to the fore at the reporting date before year end has to be determined, has to be integrated in the financial statements also. Also, discovery of fraud or error, major one, material one, showing prior statements were incorrect, has to be integrated also in the file. So these are examples of adjusting events. And the essence is that adjusting events refine the accuracy of the financial statements and the numbers to reflect the true conditions as at the reporting date. So some of these material events needs to be reflected in the financial statements so that to show the true picture. You said you made profit of 30 billion and there's a court case that wiped or sets you to pay an obligation of 10 billion. You can't let the financial statement go as a profit of 30 billion. That obligation to pay a court case of 10 billion needs to be reflected. It's also the same way round. If you win a court case or the company wins a court case of 10 billion and 30 billion was reported as profit, you can't just disclose you made 10 billion from a court case. No, that has to be reflected in the financial statement as 40 billion. So these adjusting events based on materiality are very important. So if a court case, for example, is awarding 10 million or 5 million to a company that has reported about 30 billion profit, that is immaterial. That can just be disclosed and it needs not to be adjusted. So the materiality is important, and that's the essence of adjusting these events to reflect and refine the accuracy of financial statements, to reflect the true conditions as at the reporting date. So that's it about the accounting for adjusting events after reporting date. So please feel free to interject if you have any questions. And I'm trying to run, and don't mind me if so. Please feel free. Yes, please, TA, go ahead.
Good evening, sir.
Yeah, good evening.
I want to ask this question, sir.
Okay.
And I want you to please guide me on it. What is the role of external auditor in the review and evaluation of financial statement before the reporting date?
Very good question. I'll actually come to that, but then before we get to that, let me answer that pragmatically. So, the role of the external auditor in reviewing and ensuring reporting after events after reporting date is to ensure that, number one, there is existence of those items. These items exist. Number two, management is aware of it. And number three, where necessary, there is adjustment provided in the financial statement, just to reflect the true picture. So the essence or the role of the external auditor, number one, is to confirm the existence, because some of these things may be hidden, and he needs to identify them, bring them to the fore. And that's why these events have to be properly reviewed. He needs to ask questions. He needs to check board minutes. We'll be coming to that in the course of this class. He needs to check correspondences. He needs to interview senior management and ask them. I've worked with some of these big four, and one of them will even send you a questionnaire. They'll send it to internal audit, send it to finance team, send it to whatever team that could provide them with information. They'll send questionnaire and ask you some questions. So you could divulge information on events after reporting date to them, and they will pick it to do their work. So that's the role of external auditors, is to identify and ensure that there are no material events that are out of place or that are not reflected in the financial statements. As we go on in the lecture, you will see the job of the auditor very much in this respect. All right, good question. Thank you for bringing it to the fore. Yeah, you have another question? Seeing you're trying to speak.
Go ahead, sir. Go ahead, sir. No, sir.
Okay. Thank you for that. All right. Okay, so let's look at disclosures for non-adjusting events after reporting date. So there are disclosures that shows that some of the events are non-material and they don't need adjustments in the financial statements. They just need the disclosure based on the immateriality of the amounts, the size, and the nature of the events. So we have these non-adjusting events, and these events can be defined as happenings after the reporting date that relate to new conditions, new happenings, not those existing at the year end. Not those existing at the year end. So IAS 10 guides us on not adjusting the financial statements for non-adjusting events. So, however, if these events are material, disclosure is required, which includes the nature of the events. Materiality, speaking to disclosing them, speaks to how material are they, the estimated financial impact or statement if it cannot be estimated. So what it means is that in adjusting for events, they have to be material and occur after the reporting date. But for non-adjusting events, if these events are material, then it needs to be disclosed. And the nature and size of that event after the reporting date needs to be provided, whether material or immaterial. So the estimated financial impact and what it will mean for stakeholders or decision makers will determine its disclosure in the financial statement. So some of these non-adjusting events, for example, some losses that are in a segment or in a subsidiary or in an associate, let's talk about a group setting now, that may not affect the entire group's financial statements. And from the audit of the group, the auditor found out some losses in some of these subsidiaries. They may not need to be adjusted. They may just need to be disclosed in some of these financial statements. So I'll give you an example of the former place I work in, the healthcare space. The group financial statements of that company, sometimes the auditors will look at the materiality of some of the losses of the projects, that's the subsidiary projects, the associated companies. And when they look at the material investment in those associates, in those subsidiaries, they just ignore those numbers and focus on the group. So the events speaks to the amount, the nature, and whatever it is you want to disclose in the financial statements, and the impact on whether, if stakeholders or shareholders hear of them, it will affect their decision or their meetings, the decision they need to make during their board meetings to move the company forward. And the essence of this is that for disclosure, based on non-adjusting events, you don't adjust. You just ensure users are informed by disclosures of significant post-year-end events. So if these amounts don't affect the financial statements, you just ignore it, but you need to disclose it to say, okay, this happened, and these are the amounts, but we don't need to fine-tune the figures because this is what, or this are what transpired. So that's the disclosure for non-adjusting events after the reporting date, and that of the earlier one we spoke to, adjusting events after reporting date. Okay, so let's look at section 5 and speaking to information that should be disclosed in the notes to financial statements, and how IAS 10 gives the following examples of non-adjusting events. So notes to the accounts are information that are additions or additional information to some components of the financial statements, the SCI, the SFP, and the cash flow statements. So disclosure speaks to a presentation in the notes to the financial statements. And for the events after reporting date, IAS 10 guide, example speaks to, number one, an example could be a drop in asset value. So for example, there's a fall in market value of investments. This is a perfect example of a disclosure. So maybe one class of asset, after evaluation, they found out that asset value dropped. There needs to be disclosure in the amount, the percentage of the drop. That's not necessarily an adjusting event, but then a disclosure has to be provided on that. Maybe an acquisition or disposal of a major subsidiary may not need adjustment, but it may need disclosure depending on the size of that subsidiary. Also, announcement to discontinue a major operation is an example of what needs to be disclosed as a note to the financial statements. Also, a major reconstruction that was announced or that has begun may need to be disclosed in the financial statements. Where you have an unfavorable condition like destruction of key assets by fire after year end needs to be disclosed also. And the essence is that these events occur after year end and they require disclosure only, and they may not need adjustment depending on their materiality. So this information should be disclosed in the notes to the financial statements, and this is the guide IAS 10 provides for us. So this is the question TA is asking. He said, what's the role of the auditor? So based on IAS 560, which checks IAS 10, don't forget IAS 10 is the standard, accounting standard, while IAS 560 is the checker. IAS 10 is the maker, IAS 560 is the checker. You can use that to remember this. So the objective of the auditor is, number one, to obtain sufficient appropriate audit evidence that these events between the reporting date and the audit report date are properly reflected. That's very important. They are properly identified, they are properly captured, and they are properly reflected. That should be his objective. That's the first objective. He should obtain appropriate sufficient evidence that these events occurred. These events are properly treated by management. That's the first objective. Number 2 is to respond appropriately. The auditor needs to respond appropriately to the facts discovered after the audit report date that may have affected the auditor's opinion. So any of these events, maybe after the auditor has issued his report, he needs to respond to them based on their materiality. If some of these events are material, then they may affect his opinion. If where he has declared an unqualified opinion and a major event occurred, and he needs to provide a disclaimer or even qualify the report, if management does nothing about it, then he may need to respond appropriately after these discovered facts. So the key dates after the reporting date or reporting period speaks to the audit report date. The audit report date is when the audit report is prepared, and the auditor must actively search for significant subsequent event before the audit report is signed. So the audit report date has been provided, he's done with his work, but he must search. And that's why I told you some auditors or some of these big four send questionnaires before they sign that report. Are you aware of any event? Are you aware of this? They will even provide you with examples in the questionnaire so that you can respond if you are aware of any. Also, the date the financial statements are issued but not authorized. The auditor needs to consider any new facts that arise but is not required to actively seek them. So he's not seeking for them, but he needs to consider any new facts based on materiality or crystallization of any of these risks that may culminate in material misstatements. He needs to consider them also. And the essence is that the auditor's responsibility extends beyond the year end. It's not that he has finished preparing the report and he said, I'm done. No, he needs to ensure post-reporting events are properly evaluated and disclosed to reflect the true position of the performance and position and everything the financial statements are presented to be fair and true. That is the role primarily of the auditor in assessing IAS 10. All right, we have like 7 minutes more, so let's run. Let's look at this next section on the audit work to check compliance with IAS 10. The auditor and how he checks compliance with IAS 10. So auditors' procedures for subsequent events based on IAS 10 occur in 3 phases. The first phase is the end of the reporting date. That is the audit report date. The auditor actively investigates events that may affect the financial statements before the audit report is signed. So it has been prepared and maybe is under review by the external review partner. So during that report date and the review, the auditor needs to investigate events, ask questions around what may affect financial statements from stakeholders internal to the organization and also external if possible. And number 2, the audit report date. When the financial statements are issued, the auditor considers any new events that come to the fore. So for this, there are no such required. So he needs to ensure that if the financial statements have been provided, the auditor considers new facts like events that are materially affect the financial statements to integrate them. And the third phase is after financial statements are issued. So if significant facts emerge after the financial statements are issued, the auditor assesses their impact. And if the impact is heavy, he may take action, that is, advise management to reflect these events in the financial statements. And if there is refusal, he may take action to modify his opinion. And he may also advise management to amend these events in the financial statements based on their materiality. So it depends on the judgment and materiality based on his assessment of the overall revised materiality during his audit work. So the auditor needs to check for compliance with IAS 10, and where he advises management on reflecting some of these happenings in the financial statements, he also needs to be careful in determining their materiality, their size, And where management is obstinate in responding to some of these happenings or events that the auditor has brought to your attention, he needs to take appropriate action too, depending on the materiality. So that's the audit work or the auditor's charge in ensuring he checks for compliance with IAS 10. Now, events after reporting date or event occurring after the reporting period are up to the date of the audit report is another section we'll be looking at. So during this phase, the auditor must obtain sufficient appropriate audit evidence that all relevant subsequent events have been considered by management in the financial statements. So during this phase, this is what the auditor needs to ensure. Number two, he needs to ensure that the events requiring adjustments are properly reflected in the accounts. Then those that are non-adjusting events are disclosed and are clearly reported in the financial statements. That's his job. He also needs to ensure that adjusting and non-adjusting events are properly documented in his audit working file. So the key point about this is that his goal is to confirm that no significant event, the challenge is significance. Anything that will distort information in the FS should not go or should not be overlooked before signing the audit report. This is very important. So when the report is prepared, during evaluation and review, this is what they do significantly to say, okay, has something happened? Has a risk crystallized? Has a major happening occurred to distort the financial statement? So they are very careful before they sign their audit report. So evaluation and review is the essence of doing this, and adjusting and not adjusting events are areas they check very, very meticulously and very critically. So those are the events after the reporting date and are up to date of the audit report. So let's look at normal audit verification work around evaluation and review, because auditors often gather sufficient evidence on subsequent events through routine audit procedures. So some of these start of audit field work, they also look at events through these routine audit procedures. So there are no extra tests at this period needed for this test, for this activity. But then auditors often gather some of this evidence on subsequent events through their substantive testing, audit test of details, and their audit procedures. So they have that in mind, even at the initial start of the assessment, because it has been integrated into the audit plan. So there are no extra tests needed if some of these subsequent events are adequate. So for example, we have receivables, where you have post-year-end cash receipts, confirmed collectability, or that indicates bad debt. The auditor needs to gather sufficient appropriate evidence around these receivables. Then another area is inventory. For post-year-end sales that reveals items that are overvalued at cost or at net, lower of cost or net realizable value, the auditor needs to gather sufficient appropriate evidence on these areas. So for liabilities also, if there are later invoices that may expose unrecorded year-end liabilities, the auditor needs to obtain and gather sufficient appropriate evidence around liabilities also. Then for cash, during bank reconciliations and all that, if there are dishonored checks after year-end, it may overstate cash balances. He also needs to gather sufficient appropriate evidence around cash and checks that have been dishonored. So the key point around this is, during the normal audit work itself, this work can reveal significant subsequent events that could crystallize. That's why relevant financial statement adjustments or disclosures are very imperative, and the auditor can really depict some of them during the normal course of the audit work. All right, so I had a safe landing on, yes, please, Grace, go ahead. Your hands are up.
Good evening, sir.
Yeah, good evening. Nice to have you.
Yes, sir. If I heard you well, I don't know, my network is cutting here. I don't know if I heard you well. It seems you said the auditor does not need further testing on post post balance sheet, post reporting events. If he doesn't do further testing, how will he come out with sufficient and appropriate evidence for all these issues that happen after reporting period to authenticate they really happen?
Okay, thank you very much for that question. So I was talking about normal audit verification work, and I said in the normal course of routine audit procedures, that speaks to subsequent substantive testing, test of details. He could find subsequent events that have already answered his question on adjusting events and not adjusting events. That's why he may not need extra tests. That's what I'm saying. But if he doesn't find, then he will need to perform extra tests after the audit report has been prepared. So when the audit report or the field work was going on, and he finds some of these subsequent events that were not in the financial statements, through correspondences, through minutes, through some ways that were not documented in the financial statements, then he doesn't need any extra tests. He already has his audit evidence. And some of them I spoke to, I said receivables he was auditing. He found out some post-year-end cash, and he confirmed this. He also checked inventory. He also has liabilities, cash. Some of these things during normal audit verification work has already solved the problem. So he may not need to go into any detail. He just brings it to the fore that, okay, management CEO, in the course of our audit, we find out that this needs to be adjusted in the financial statement. And don't forget, most audits are done after the year's financial statements have been presented. So for 2025, at this period, some people may be auditing for 2024. So in doing the work and some of the minutes you gathered, including some minutes for 2025, you may find subsequent events during the normal course of the audit work that were not in the financial statements prepared by management. So you need to call them to adjust. That's why I'm saying no extra test is needed if the auditor has already found most of the subsequent events through his normal audit work. But if he doesn't find any, then that means management has either integrated it or they are hiding it. So he will need to perform tests and procedures and also ask questions to satisfy that he has done his job very thoroughly. So that's what I'm saying. I hope you got that, and network didn't distort my thoughts going on that.
Yeah, it's breaking, but I think I got what you said.
Okay. Okay. All right, you're welcome. Let's stop here. It's 9 p.m. already.